Hello, everyone. I'm Ken Berlin. I'm a senior fellow at the Atlantic Council's Global Energy Center, where I'm director of the program Financing and Achieving Cost Competitive Climate Solutions. I want to welcome you to this program on how to build jurisdictional approaches to forest conservation sequestration and why that is so important. I'm sorry I can't be with you in person, but I had back surgery a few weeks ago, and I'm still a week or so away from going into the office. My colleague George Frampton, who is a distinguished senior fellow at the Atlantic Council, will moderate today. George and I, with our colleague Frank Willie, have been arguing that there is a need for a huge increase in private climate investments in emerging markets and developing countries in order to meet our Paris climate goals. We have focused on evaluating what kind of new transformative financing instruments and structures are needed to mobilize this capital. With increasing community use of guaranteed structures, we've developed a significant proposal for a sovereign and large donor-funded guarantee facility that will be directly available to private investors on a portfolio basis, including investments in nature-based solution programs. Today, we are going to discuss a second area we've been working on, the future of private investment in forest protection in developing countries and emerging markets through voluntary carbon offsets markets. A recent paper we published with longtime expert Byron Swift concludes that despite the fine work being done to ensure the integrity of project-based credits, there are fundamental flaws in the basic concept of project-based REDD+ transactions. We argue that it is critical for the carbon credit market to move towards large-scale jurisdictional transactions with indigenous, state, and national governments, and why jurisdictional programs are far more likely than project-based programs to reach the scale necessary to increase significantly carbon sequestration. Of course, many others are also working on this approach. Byron is going to speak first. Following Byron, a panel of 3 participants who are deeply involved in structuring and financing jurisdictional forest transactions and ensuring the integrity of forest credits will give us an update on their work and talk about how these deals are structured to be credible and how they see the challenges ahead. The program is public, on the record. You can follow us on Twitter at AC Global Energy and use the hashtag AC Energy. Second, we encourage you to submit questions. For those on Zoom, you can use the chat function to raise your hand, and we'll try to get to as many of you as possible. With that, I'm going to turn it over to George.
Thank you, Ken. I'm George Frampton. I think we have a informative and interesting program for you today. As Ken mentioned, Byron Swift is first going to talk about the paper that we've just published, of which he's the principal author. Byron has had a very distinguished career as an environmental lawyer, working with Environmental Law Institute and EPA on pollution issues, but also more than 3 decades working on nature and forest protection in Latin America. He ran the U.S. office of IUCN for a while, was president of Rainforest Trust, among other important roles in the community. Then we have 3 very experienced presenters from 3 different organizations, each of which is now playing a lead role in originating and structuring jurisdictional forest protection transactions with governmental entities in the Global South. First, Julia Peltseva is the Senior Manager for Technical Engagement at ART. ART is Architecture for REDD+ Transactions, ART, an independent organization that's hosted by the Winrock Foundation, but which has developed a standard called TREES for monitoring and verifying emissions reductions from forest sector that's applicable to jurisdictional transactions. So it's sort of the gold standard for evaluating the credibility of jurisdictional transactions and is able to issue credits for programs that win their approval. She previously worked on these issues at the Environmental Defense Fund. Edwina McKechnie is Executive VP for Corporate Engagement at Emergent. Emergent is a nonprofit organization that serves as the secretariat for the LEAF Coalition. The LEAF Coalition is a coalition of countries, including the U.S., and companies that want to fund forest credits on jurisdictional lines in transactions with governmental entities. And Emergent is actually they are the secretariat for LEAF. They are doing the negotiations with governments to consummate these transactions. And finally, Jessica Arrigo, Director of Natural Climate Solutions for Mercuria Energy Trading, which is also becoming a first mover in doing jurisdictional forest transactions. She was formerly at ART, the American Carbon Registry, worked in forest carbon markets for more than 2 decades, and is now with what Mercuria is a privately owned, originally energy trading company, global, which is going into the business of more natural solution investments. So Byron, I'll turn it over to you.
Thanks, George. And I'd like to thank the Atlantic Council for holding this forum and allowing us to discuss these topics. I'd like to start by giving a brief summary of the paper my co-authors and I wrote that discusses the problem with project-based carbon credit programs and the need for jurisdictional alternatives. And as George mentioned, my background is twofold. I'm both an environmental attorney that's worked a lot in air emissions policy and programs with Environmental Law Institute, doing a lot of work for EPA, with a particular emphasis on emissions trading programs. And most of my life, I've also worked on the conservation of forests and protected areas in Latin America, currently with Rewild. I'd briefly like to discuss the findings of our paper on the carbon credit trading programs. And we've just defined two kinds of problems. The first are structural problems with the credit trading concept when applied at the project level. The first and most important is probably the lack of integrity of these programs. They're very difficult to do a credit. You have to show additionality and how to prevent leakage. Those are very difficult concepts to prove, and they're easily subject to gaming, cherry picking the best projects and things like that. And also, they have a major problem in that the economic incentives they create can be opposed to they don't align with the social benefit on the ground investment, which is treated as a cost to the implementers. The second structural problem is the very high transaction costs these credit trades involved that can absorb up to 50% of the total cost. And the third is the longevity problem, which is a problem for most biological sequestration sources of carbon, which is that carbon dioxide lasts in the atmosphere for over 300 years, whereas the average trade program will only last for 20 or 30 years, potentially leading to many more emissions of carbon over the long term. In addition, the work I've done in the Amazon and in these countries over the last 40 years has exposed me, well, 25 for carbon, but exposed me to the practical problems these carbon credit trades create on the ground. Just to list some of the problems we discuss in greater detail in our article is the arbitrariness and inequity of the application of these programs. They can be existing in one community, which gets a lot of money, and then the next communities don't. That can lead to social conflicts. There's a lack of transparency in almost all of these trades on issues such as price, sales, and fees. The receiving communities and governments rarely know the information on those. The third is the cultural and capacity differences in the relatively sophisticated carbon traders and the rural communities and indigenous peoples and subnational governments who are involved, and that we've seen leads to often leads to very one-sided contracts. Finally, there's increased social conflict over land and money that these programs can generate, and there are profound disincentives to the communities to conserve their lands through other methods, because the carbon traders will tell them, well, you've got to wait until you can get a carbon trade before you protect your lands. You can see that going on all over the Amazon. And all these problems, so I've listed about 4 major problems. Any one of those is enough to not pursue project-based carbon credit trades. And collectively, they present an overwhelming case not to do so. And they can all these problems can be reduced by well-designed jurisdictional programs, as we'll see in the subsequent talks. Jurisdictional programs and other methods. I'd like to take a little bit of time to reflect how these problems we've identified with the carbon credit trading, project-based carbon credit trading markets apply to using financial or market mechanisms in general to promote social causes. Market mechanisms are intended to allow for for-profit actors to accomplish a social goal. But the above problems indicate the need for a number of enabling conditions that will make these mechanisms work effectively. First, I think we understand that these market mechanisms will work well, they're going to have to operate within a defined legal or policy framework. As without it, the market incentives can cause traders to simply focus on revenues instead of the social goal. Nested jurisdictional programs can have strict and easily applied rules that avoid these problems. And then there are ultimate solutions like cap-and-trade programs that are actually regulatory programs that implement a strict program. I'd love to talk more about that, but I think you can ask questions and, on these, and also feel free to contact me if you have further questions. The second with market mechanisms is the more sources that can be included, the better. The bigger the area of the controlled market within the system, the better. And that's a major argument for jurisdictional trading. Third is the more equal the bargaining power between the parties, the better. Verification requirements are one way to address this problem, and they've been advancing. But it's also, I have seen, generally desirable to try to eliminate, given the situation, eliminate the direct interaction between carbon traders and the individual landowners. You can avoid that by nested programs, and you can avoid that by cap systems and other jurisdictional systems. And finally, the simpler the monitoring system, the better. There have been advances that allow us to measure carbon stocks, and that's a much easier system than trying to measure carbon flows, such as additionality. To turn to solutions, we feel that jurisdictional carbon credit trading programs are a major solution that we should try to implement. These are landscape-level forest conservation programs, and their size greatly reduces the opportunity for leakage. They're typically in the millions of hectares and can be at the state or the country level. This gives them much greater integrity because it reduces the opportunity for leakage. But perhaps equally important, jurisdictional programs are typically implemented by social actors, such as governments or indigenous or associations. And that creates a context in which these actors can also control or address the other major policy elements that you need to have a successful carbon program. There are things like establishing the rule of law in these areas, the capacity building of the government organizations involved, because the deforestation frontiers where you have high carbon values and high deforestation, that's where the crediting programs are taking place, but those deforestation frontiers in remote forests are very messy areas. You need to address a whole bunch of social problems there to create a positive conservation outcome. And again, social actors will do that much better than carbon traders. You've got to hold everyone's feet to the fire on these. It's not like it's a free lunch, but I think these are the ways forward. We also point out in our paper how establishing a jurisdictional program at the state or the country level minimizes leakage. And in a sense, this is highly positive because it's the country level that has the obligations under the Paris Agreement to address carbon. So if you could do a jurisdictional level at the country level, it's even better. It's not necessary, it's better. And it's important to note that these larger jurisdictional programs can now be more easily implemented because of advances in satellite monitoring of above-ground carbon levels. You can literally get a number for a country or a state that you can measure progress with. And with proper design, they can be equitable, transparent, and greatly reduce transaction costs. One of my favorite examples is the Socio Bosque program in Ecuador that has similar programs in Costa Rica and Brazil, but they create a government-operated program that is transparent and easily accessed by communities and individual landowners. And then the crediting program takes later between the government and possible buyers. And finally, you have inclusive cap-and-trade programs at the jurisdictional level that could be the best global solution if we can find a way to make these enforceable. They're high integrity because they're regulatory, and they have accurate monitoring with satellites, as I can say, and so they could be established at the country level. We feel that if states and provinces are committed to reducing their deforestation rates, and if they were to use any of these broad-scale jurisdictional programs, we feel that could assure them significant funding levels for sustainable development and for their future. I hope this overview of the opportunities presented by the jurisdictional programs is useful, and I look forward to the upcoming panel discussion on how to turn these great ideas into action. Thank you.
Byron, thank you very much. Julia, tell us about art and art trees.
Great. Thanks, George. Hi, everyone. Thank you so much for having me on the panel today. I'm very pleased to represent the Art Secretariat. The Architecture for REDD+ Transactions, or ART for short, is a global carbon crediting program that certifies emissions reductions and removals from protecting and restoring forests at large scales. These activities are often referred to as REDD+. That's an acronym. It stands for Reducing Emissions from Deforestation and Forest Degradation. The plus stands for Sustainable Forest Management and Conservation of Forest Carbon Stocks. REDD+ isn't a new concept. It's been part of the UNFCCC framework for about the last 2 decades. ART itself was founded in 2018, and we operate in both compliance and voluntary markets. We are independent of the governments or any buyers that either sell or buy the credits that we issue. Our purpose is to incentivize governments to protect their forests from loss. This is especially relevant because emissions from the land sector continue to represent about 20% of the world's emissions every single year. So we're trying to operate in a market framework that's valuing trees more when they're alive rather than when they're dead. And in order to grow a market, you need to inspire confidence in the market participants. So that's really ART's role, is to help ensure the integrity of the supply, which in our case is represented by the credits that we issue. So just for a sense of some market players, in the carbon market, we are a standalone crediting program. We consist of the Art Secretariat. We also have an advisory board. We have our own registry, which serves as a sort of ledger that tracks all the credits. And we also have our own standard called TREES, as you mentioned. It's an acronym. It stands for the REDD+ Environmental Excellence Standard. And TREES is really a rule book that lays out all the requirements for monitoring, measurement, reporting, and verification, along with social and environmental safeguards. Our distinguishing feature, as has been mentioned, is that we only credit at the jurisdictional scale. So that means that all participants in our program have to be either
national governments, so the entire country must participate, or large subnational governments, which is either a state or a district. The terminology just depends on the country in which you're operating. And we do offer a pathway for participation of national level submissions of recognized indigenous territories. Right now, we have 20 jurisdictions that are in the pipeline. Of these, 14 are national governments and 6 are subnational governments. And so far, we have issued 2 rounds of credits. These both went to the government of Guyana for their Red Plus program. And we do have a couple other jurisdictions that are undergoing verification. For a sense of the process, from the jurisdiction's perspective, if a jurisdiction wants to participate in ART, it would design and implement its Red Plus program. It would monitor those results and report on them, and then they would independently contract a third-party auditor called a validation or verification body, VVB for short, and that is an independent party from ART. They really go in and check all of the reporting and implementation of the government's Red Plus program to see whether it conforms with TREES, our standard. They would then issue a report that ART would review, and if we find that the jurisdiction's Red Plus program was in fact done in conformance with TREES per the VVB's audit findings, we would issue them carbon credits. We call them TREES credits because they're in accordance with our standard. And those would be issued on our ART registry. They're tracked there. And once they're issued, the jurisdiction could transact them with any interested buyer. And that transfer or any subsequent cancellation or retirement of the credits would also be tracked on the registry. And you can see that today if you go on our website to see what has happened with the credits that we've currently issued. ART is proud to be recognized by multiple integrity initiatives within the industry. So most notably, ICAO's CORSIA, that's an emissions trading scheme for international aviation. We are one of only 2 programs that are fully eligible to supply units to the first phase of CORSIA. We are also approved at the program level by the ICVCM, which is the Integrity Council for Voluntary Carbon Markets. And to start to transition, another important group of stakeholders in the market is the buyers. They're here, so I'll let them speak more about what they do, but just to note that TREES credits can be transacted with any buyer, so a jurisdiction may choose to transact with an individual corporation or a coalition of buyers, such as those represented by the LEAF Coalition. They may choose to transact with another government under bilateral trade agreements, such as those offered by Article 6.2 of the Paris Agreement, or they may choose to receive results-based payment for the verified credits. And I will emphasize that as an independent crediting program, we're not involved in the terms of the transactions. We don't participate in negotiating ERPAs or emissions reductions purchase agreements. Participating jurisdictions can transact with anyone that they want and set their own terms for those transactions. They would just be independently and transparently tracked on our registry. And I think the note that I want to end on is a positive one. I think the market has been quite receptive to governments certifying their Red Plus results under ART. There's been over $4 billion publicly committed to purchasing TREES credits, and some of these payments have already been made. So we're really excited to contribute to climate action and protect standing forests.
Thank you. That's very complete. So ART basically works with a government, a country, a state government, to evaluate. The government wants to set up a program to protect forests and sell credits to do that. And you work with the jurisdiction and you evaluate against your standard whether that's a program that's going to satisfy your requirements. And if it does, then you'll be prepared to issue those credits and register them in the private market if they're buyers who come along. But you don't get involved in the transaction between the buyer and the country.
That's correct.
So Emergent is now a principal in actually negotiating these transactions, initially or primarily for this LEAF coalition that was countries and now companies that want to buy the credits. So tell us a little bit about what Emergent is doing, the status of these negotiations, and most interested in, what are the biggest challenges? What are the biggest hang-ups that prevent consummation of more of these transactions?
Great, and happy to. Hi, everyone, and thanks to Atlantic Council for having us today. As George outlined there, I'm Edwina. I work for Emergent. We're the nonprofit coordinator of the LEAF Coalition. Just as sort of a little bit of context, I lead corporate engagement, so that's really bringing to the table the private sector buyers of jurisdictional REDD+ forest carbon credits certified to our trees. Taking a step back, Emergent, we're a nonprofit. We were put in place with a mission to halt and reverse tropical deforestation by 2030, in line with global climate and nature goals. The way we do this is through catalyzing this new market for jurisdictional REDD+, and importantly, a high integrity market, and really seeing the mobilization of large-scale finance as being very crucial in terms of changing incentives on the ground for forest preservation and restoration. And as Julia nicely put it, making sure that forests are worth more standing than for alternative uses. So Emergent to date, our focus has mainly been on the LEAF Coalition. LEAF is a unique public-private partnership. We were launched in 2021 at the Glasgow COP, and we bring together over 25 corporate climate leaders, increasingly nature leaders as well, together with 4 sovereign donors. So that's the United States, the United Kingdom, Norway, and Korea, to transact jurisdictional REDD+ our trees credits, with now the 20 jurisdictions that are currently participating in LEAF. A key role at the start of the coalition was to provide a very clear and significant demand signal from the private sector with support of donor funders to really demonstrate the power of this market and to catalyze and get it off the ground. So in the 2 years since we've been established, or 2 years plus, we've raised over $1 billion in commitments from public and private sector players. And at COP28 last year in Dubai, we announced the first ever multi-company as well as sovereign donor agreements with the governments of Ghana and Costa Rica for up to $60 million in results-based finance. So that is for the results, so the emissions reductions and removals credits from the jurisdictional REDD+ efforts that they've implemented across their national boundaries. I'd say with that sort of momentum and sort of proof of concept at COP, we've seen a lot of enthusiasm sort of injected into this area. We're seeing very much momentum on the jurisdictional side as jurisdictions prepare and move towards deals. We're also seeing momentum on the demand side as well, as companies in the coalition move forward to a new pipeline of deals that we have online covering forest biomes across Central, South America, Africa, and Southeast Asia. We have a particular focus on Brazil related to the political leadership and demonstrable results to reduce deforestation in recent times. And that is, of course, part of the flight path towards COP30, which will be hosted by the Amazonian state of Pará in Brazil at the end of 2030. So a moment to really show a really significant moment for this market in the heart of the Amazon. So maybe because I work on the sort of private sector engagement side of things, I'll share a little bit more about the sort of private sector participation and why jurisdictional. Why does jurisdictional and jurisdictional Red Plus and Archeries in particular resonate? And I think when we started LEAF Coalition, we had several leading companies together with the sovereigns and civil society partners that were involved that really recognized that we needed to address the root causes of deforestation. Large-scale finance is needed. Whilst public and donor finance is significant and plays a very important role, it's simply just not enough. So how do we get the private sector to lean in, to step in a meaningful way? And we really see market mechanisms like the high-integrity voluntary carbon markets playing a key role in that, and a key tool for the private sector to be able to scale the type of finance that is needed. But the private sector needs confidence to engage in a meaningful way. And I think anyone who's been following the voluntary carbon markets for a while sees that, there are ebbs and flows in where that confidence lands. And from our perspective, the jurisdictional approach and high integrity standards like Archeries is a really powerful way and has a number of very powerful levers that mitigate some of the risks that we typically see at project level. I will say that we also, see projects as playing a very key role here. And there's lots of good projects out there, but jurisdictional is complementary in that it, as is already mentioned a few times, it helps to change incentives on the ground. It gives a viable alternative for landowners, wider stakeholders, governments to choose a sustainable development pathway that values the forest standing. And I think that key word there around government is key. And a government plays a role at a jurisdiction, across a forest jurisdiction, that nobody else can play. They set policy, set policy incentives, deliver programs in and around enforcement, monitoring, etc. I think accounting has been mentioned as well. Inventory accounting, it helps to address some of the criticisms at project level around counterfactuals, overinflated baselines, et cetera. So all of these issues helping to address some of the issues around permanence and leakage that, inventory accounting and accounting more general that we see at project level. I'll then just note on the sort of scale side, of course, governments and Archeries is operating at, national and subnational level. That obviously avoids the risk of leakage, which is key from the private sector, and importantly includes benefit sharing and active and inclusive participation of key stakeholders, importantly the custodians of the forest, the people that we know that are most essential to ensuring that the forest stays standing, make sure that they have the direct resources that they need, but also an equitable share of the benefits for these types of large-scale transactions. So LEAF, of course, brings together high integrity on the supply side, and we do that through Archeries and the benefit sharing, environmental and social safeguards that it is integrated within the standard. But we also look to catalyzing a high integrity market on the demand side. So recognizing criticisms of the market, ensuring that the buyers that are part of the coalition are investing in jurisdictional credits in addition to, not instead of, the deep decarbonization that needs to be happening in their own value chains. Emergent as a nonprofit, the principle in the transaction also ensures that the maximum revenue flows, any margins, are redirected back to forest communities, and that, of course, there is a strong fund management and reporting and monitoring process in place that meets private sector participant expectations. And maybe just finally, from the private sector perspective, there is a value in catalyzing a market and coming together with peers that you know or have similar values and purchasing practices, and working with a sovereign guarantee in the deal itself, but also from a foreign policy perspective, noting that the governments, the donors involved, are also supporting this very much on a policy standpoint as well. So lots of learnings, I think, on the demand side around how we can build integrity in the market, integrity and jurisdictional. There's lots happening in the voluntary carbon market. There's VCMI, there's ICVCM, SBTI, others all working to build confidence. And we think jurisdictional provides some important differentiators that help to build that private sector participation, confidence in the market, and that fundamentally that is crucial and needed. And I will just add, we do need more of these types of engagements with broader stakeholders to raise awareness, to ensure that stakeholders are aware of the opportunity, aware of the integrity parameters that have put into place, and from a private sector perspective, have the confidence to lean in and lean in significantly so we can meet the expectations of both the jurisdictions involved in LEAF, but also what we need in terms of our global climate and nature goals, and to deliver at scale and pace. So I've got lots of other learnings I'm sure I could share more on the jurisdictional side, but I'll pause there and
Thank you. Well, that's really interesting. And LEAF, of course, started out a public-private, but a public initiative, the U.S. and Norway, and then the U.K. and now Korea, as a way of sort of mobilizing private investors to get into this. Mercuria, Jessica, is totally a private initiative to start with, a company that obviously thinks that this is a attractive business, as well as important mission to protect forests. So how looked at from a purely private business point of view, how does it look different, and what do you find are the biggest challenges to consummating? What are the big hurdles you see that you're going to have to get over to actually invest the funds that you've committed to this?
Okay, yeah. Well, thank you so much for having me here, and to the Atlantic Council for this great invitation. And also thanks to my panelists for setting such a good scene and providing so much context, and to Byron as well. So just a little bit of background on who Mercuria is. Mercuria is the third largest energy trading company globally, privately owned, based in Switzerland, with a staff of about 1,400 people. Mercuria largely covers commodity markets in the energy sector, also minerals. And then a few years ago, Mercuria's owners committed to making all new investments contribute to the energy transition by 2025. Half of all new investments. And that has already been achieved. Over $1 billion has already been deployed there. Then more recently, Mercuria committed $500 million as a set-aside investment vehicle into nature. So that will focus on a variety of assets and activities, including with an emphasis on and including activities that restore nature, protect biodiversity, and also focus on jurisdictional REDD+. The way we work is that we have geographic focuses. So we find it very important to have boots on the ground where we work. So we have, for example, equity investments in project development companies in Mexico, or we have a portfolio of 30 nature restoration projects. We have a team on the ground in Peru, and also on the ground in Brazil, where we have portfolios as well. In terms of jurisdictional REDD+, we have partnerships with 2 subnational governments, one in Argentina, the provincial government of Misiones, and also the state government of Tocantins in Brazil. The way we work with them is that we invest upfront. We cover all of their costs to set up these programs, and it's not just to enter the carbon market with all the documentation and verification costs, which of course we cover, but also to meet all of those other important pillars to make REDD+ jurisdictional programs have high quality and integrity. So those include developing the MRV system, developing a safeguard information system, developing and implementing a benefit sharing program, articulating a REDD+ strategy, but also building that capacity to do all of these things. So that's really, really important, because otherwise you have a chicken and an egg where the finance doesn't come until after the expectation that all of these things are in place. So we have to kind of get that finance up front and make sure that we can help and shepherd those pillars, the development of those pillars up front. And why is JRED important? Why do we think that it is such an important investment? Well, we really do see that the direction of travel is towards JRED. We still definitely have project investments. We think that project investments can really focus on biodiversity and nature hotspots. They can have a very high quality engagement with local communities and indigenous people if done right. I think that all of the issues that Byron pointed out can actually be addressed. However, we do see a growing interest in jurisdictional RED+. We do think it's extremely important to boost the ambition at the government level to reduce deforestation. There's really a lot of things that only a government can do to reduce deforestation and degradation. Governments, and only governments, have the authority to control and reduce deforestation by implementing fiscal levers and policies, by providing incentives, by controlling illegal deforestation, by improving governance, controlling concession permitting, and so on. The range of things that only a government can implement are very, very key to reducing deforestation and driving this ambition. And then, as my panelists mentioned, JRED also addresses these pervasive issues that keep on coming up from the critics about the carbon market. So, the leakage, the additionality, the reversals, and certainly the safeguards. So not that you can't address these in projects if they're done correctly, but really just by design, these carbon principles are inherently met, in our view, in the jurisdictional programs. So why did it suddenly, why did we feel like it was so, why did these voluntary programs emerge? Well, I mean, really, as Julia mentioned, jurisdictional RED has a long history. I mean, it was brought to the table in 1997 in Kyoto. In 2008, the plus was added to RED in Poznan, I believe. In 2010, the Cancun safeguards were created. In 2013, the Warsaw Framework was created, focusing on carbon accounting. This has been around for a long time, and governments have been piloting these systems since shortly after the Warsaw Framework was published. To fund these pilot programs and to develop that readiness and that capacity, these multilateral programs like the GCF, the World Bank's Forest Carbon Partnership Facility, the RED Early Movers, and also the bilateral agreements like Norway and others, stepped up to fund these things and pay for those results. But it was important to many stakeholders that and we came to understand kind of collectively in the market that it was really important to find a way to attract private finance into this market and into these jurisdictions. So that's when ART and JNR emerged. And we also, I think that another important thing is that the emergence of these standards has allowed fungibility and consistency across all the credits, because under the UN system, every credit was a little bit, there weren't really credits, and every program did their own thing because there was a large range of capacity and abilities to conduct these systems. So now there's fungibility and consistency, and it can be introduced into the market. So in terms of challenges, I mean, what are we seeing? I think the key is, in order to develop all of these pillars that I mentioned in terms of, the MRV system, the benefit sharing, and the safeguards, and the RED strategy, and so on, there really does need to be a lot of finance. And to have a lot of finance, we need a very solid amount of demand. Without demand, we're going to make promises, just like Byron mentioned, to the projects. The same thing could really happen. So in our view, that means a lot of socialization of to the buy side, to the demand side. There is a lot of misconception and negativity about the market. We see that we see a lot of initiatives trying to address those issues. And we also see, in terms of on the investment side, I think we have actually changed our investment behavior, and we're extremely curated and extremely sensitive to the integrity of the programs that we invest in. So, you know, we're seeing a change there, but we have to keep on working on making buyers comfortable and really explaining the benefits of jurisdictional RED, because I'm not sure that education is complete yet. So we have to continue to work on that. Other than that, I mean, I guess I would just say that I think that we are very excited to see the supply coming in, the interest from the countries. There's 20 countries. I'm sure that there are many others in the background thinking about it and thinking about how they can enter, and if there's enough demand and how they can build that capacity, and if there'll be enough finance for them to do that. So I'm really happy to be kind of in this historic moment of the JRED market.
Well, this has been very useful. Thank you very much, all of you. I want to have the opportunity to take a few questions. There are a couple here on my panel from people who are watching virtually. One of the questions that came in that you had mentioned is about the role of project-based or smaller transactions being nested within a jurisdictional framework. How would that work, and why does that help lend credibility and perhaps transparency to a project-based? I can ask anyone who.
I can take a stab.
Take a shot.
Nesting, the concept of nesting is to align accounting between projects and jurisdictions. Whether or not there is actually a jurisdiction in place, you can align that accounting, meaning that the deforestation or degradation rates that you see in the jurisdiction, well, the projects really only get a piece of that. They shouldn't just get kind of what they're seeing in that local tiny section of their project. And that was one of the criticisms that a lot of RED projects have been receiving, is that they were able to, quote unquote, game the system to allocate inflated baselines. So the nesting inherently resolves that inflated baseline issue by aligning that. Now, nesting is going to, so the vast majority of RED projects, so the project scale RED projects, are listed under the VERA standard. And VERA currently is in a transitional period where they are introducing a new RED methodology that effectively requires that type of jurisdictional baseline setting for all RED projects. It's been a multi-year process. They are now in the process of externally creating these data sets that will be used to allocate the baselines to projects. So that's kind of going to be how it works. I mean, it might be interesting to hear Art's view on how that's going to work and with the VERA projects, because I think that a lot of projects in the art jurisdictions will be interested to understand how they'll align there. But that's how nesting works. So it's very, very essential to address some of these baseline concerns.
Let me ask you a related question. Go ahead.
Sure. Just a very small follow-up comment on that. So again, ART only credits at the jurisdictional level, but we completely recognize the importance of all of the participating stakeholders that help deliver these results. And some of those are project proponents or indigenous peoples or landowners, and all of them help deliver the actual results that are being verified. So those activities can then choose to participate in this jurisdictional program, and maybe they are the outlines of a project as it was traditionally defined, but then that project proponent can choose whether they want to align their baseline accounting or if they want to participate in the national level program and receive a portion of the trees credits that would be then issued to the national government. They could come to their own terms of negotiations of how to divide up the benefits, really. So I would say there are a lot of different ways to do nesting. It really doesn't have to be either or. And I do think there's a growing recognition that making sure the accounting makes sense on a national scale is really coming to the forefront here.
Well, one of the huge benefits of jurisdictional programs is they're easier to measure, in a sense, right? Because you can look at the entire state or subnational or national stock, the entire forest stock, and increasingly we're able to measure the increase or decrease of the entire stock through satellite imagery. So you can look every year at how they're doing or not doing in a way which you can't do exactly the same way for projects. On the other hand, a disadvantage, I mean, with governments you get more transparency, more certainty, hopefully more programs of actually working in the community. On the other hand, you're dependent on the government's policy. So what happens if policy changes? So how do you look at the guarantee? What kind of guarantee do these transactions get from the jurisdiction about its policy remaining constant, or about whether if it doesn't, there's some payback or surrender or clawback for the people who are buying the transactions? How does that work? What does the government guarantee, in other words?
Happy to take that one and speak a little bit to how we structure things at Emergent and LEAF. So at the moment, we're looking at future offtake agreements. Those are done with the jurisdiction for a crediting period of 5 years compared to a preceding 5-year baseline. So that is looking at forecasted out emissions reductions and removals resulting from the efforts and the results of the jurisdictional RED Plus programming. So within that contract, there are a number of safeguards in terms of under delivery, et cetera, but also there is an incentive at government level, irrespective of the administration empowered to deliver on those contracts, because there is a forecast of scaled finance and revenue coming through to the Environment Ministry or the Forestry Commission, whatever it might be. I think with that, within the standard, there is a whole load of different aspects around buffering and looking at reversals, et cetera, that is, in the accounting and the standard itself. But I'd say multiple elements in both the contracting as well as the standard around the emissions reductions and removals. I will say in the case of LEAF and catalyzing these new agreements, there are also sovereign donor contributors to these agreements. So the UK, the US, Norway are participating in these agreements as a sovereign guarantee. So they're able to guarantee a floor price. So there is an incentive to do the agreement to begin with. But they also are there as a guarantee in case of under delivery, or if for whatever reason a buyer steps out, being able to provide that demand signal and reach a transaction volume that is of interest to the jurisdiction and the government involved in these agreements.
I just want to turn out and see if there are questions in the audience. I have a couple virtual questions. If I don't, yes, please. Can you just identify yourself?
Emmeline Willie with Opus. So spoiler alert, I'm asking about pricing.
I'm not sure that's on. Is it on?
I'll just talk louder?
We can hear you.
Talk louder.
Okay. Emmeline Willie with Opus. I was curious if you would be comfortable talking a bit about pricing. What kind of premium would you expect J-RED credits to carry compared to non-jurisdictional RED Plus credits?
Pricing. Start with LEAF and then Mercuria.
Happy to speak a little bit to that. So, as mentioned, we, at the start of LEAF, a floor price was included in part of that demand signal to the market, to the jurisdictions, to see if they wanted to participate in this approach. That floor price was at $10 a ton. That is negotiated on a deal-by-deal basis. I'd say, related to that, there are limited credits in the market that have been issued. I think once we start to see more liquidity in the market and more high integrity jurisdictional credits coming online, starting to get some of the sort of price indices, et cetera, that we'd look to reflect high integrity supply of jurisdictional red, both from the reductions as well as removals, noting, of course, that credit type plays a key factor here as well.
I mean, I can add a little bit, but similarly, I really can't speak to that differential between project and jurisdiction, except that there probably will be one. But because of the lack of transparency, there's no indices right now or exchanges that show that pricing. There's not enough liquidity of jurisdictional red, but also because there's just these inherent inbuilt differentials that are really, we know that there's going to be differentials, but we don't know what they'll be yet. But we certainly think that a credit, even within jurisdictional red, with a corresponding adjustment, will be higher priced, or perhaps removals versus reduced emissions, there will be a differential there. Vintage also plays a role. HFLD versus non-HFLD will probably also play a role in pricing. So I think there's a lot of components, so it makes it very difficult to really know, because even just within that one project, the jurisdictional red type, I think we're going to see a big range.
And I guess my quick thoughts on this, again, we're not involved in negotiating the terms of the transactions, but just commenting on what has been publicly announced as available information. The credits that were issued to the government of Guyana transacted for a staggered range of prices, but the average is about $20 a ton, and it really just emphasizes the point that these governments can really be flexible and can negotiate the value that they think that they bring to the table. And I think there is a lot of understanding of the upfront work that needs to go into delivering these results, and more buyers are recognizing that they really need to pay a premium for what these governments are able to deliver.
The question from the virtual audience: is the actual measurement of the national stock forest, is that a particularly expensive item in the overall cost of these? How much do you have to allocate to do the remote sensing and the reporting and the evaluation every year?
Again, it's really,
or every 2 years, or every
it depends
5
on
years?
the entry point, because, for example, as I mentioned, the UN system had a long history of RED plus TA funding. So some of the countries have already been receiving readiness funding for many, many years and have a well-established MRV system. So those countries probably don't need that much or any funding to make their MRV systems ready for submission to or JNR. Others, certainly subnationals, in some cases, some subnationals have received funding, many others have not. Some have not, and those who have not are starting from zero, and so it can be a little bit costly. And it also depends on whether a country has, for example, a national forest inventory or not. And then the other thing that I think is important to note is that both R and JNR require the quantification of degradation emissions, so emissions from forest degradation, and many, many countries and subnationals have not really done that accurately yet, or have not done that at all, just haven't tackled it in their FREL submissions to the UN, for example. So that's an area where, and that's because it's complicated and it's highly inaccurate at some point in terms of high uncertainty. So there's a lot of work and money being spent now to improve those MRV approaches for degradation. But that would be, I would say, the area where I think probably there would be the most cost, the most investment needed.
In the UN FCCC system, it seems to me that over the last year to 2 years, there's been an increasing nervousness, if not hostility, toward certainly governments using offset credits to meet their Paris targets, but also companies using too many offset credits to meet their zero carbon pathway. And yet, obviously, CORSIA is an example. The airline industry depending tremendously on offsets to try to reduce overall, to make a contribution to overall climate. Is that a sort of a headwind for trying to really scale up REDD+ jurisdictional credits, or not? Do you think that the market is really out there in a big way if this can be done in a way that has credibility? Any thoughts about that?
Happy to speak to the private sector perspective and the sort of company use case or orientation in terms of use of credits. And indeed, there has been a fair amount of criticism or backlash around, how companies are communicating and talking about the use of credits and offsetting in particular. That's part of the reason why LEAF has its buyer's criteria to stipulate transparency around use of credits in addition to rather than instead of decarbonization. But what we're seeing, particularly in the sort of climate leadership and nature leadership space, is a recognition that whilst a company transitions to net zero, there is a need to compensate for the emissions. We don't reach net zero overnight, and there is an impact happening, and meanwhile, near-term mitigation finance is needed. So companies that are looking to, whether you call it offset, compensate, counterbalance, their footprints on the pathway to net zero, mid-century net zero is really, really important from a global finance, climate finance point of view. I would also say that there's increasing to the points around how the market integrity piece is shaping up, initiatives like the VCMI around how to adequately claim use of credits is also helping to facilitate and work through that from a corporate perspective. And finally, just to note, in the absence of a carbon tax or a regulated market, there are increasing disclosures on companies in the direction of the direction of travel, towards regulation and actually putting a price on carbon, investing in the voluntary carbon market now. There's been several studies that come out that demonstrate that by participating in the voluntary carbon market, compensating your emissions, you're putting a price on carbon, and it actually accelerates the decarbonization in own value chain. So I think there's growing, again, socialization of these issues, building frameworks around how at least the private sector is developing and articulating the use case for credits from a business point of view. Maybe over to the others to speak around the
summary.